हम सब की अंतर प्रेरणा। एक कदम, एक छलांग, एक बाजी, एक गहरी सांस और एक ललकार खुली हवाओं में कि हाँ मैं बना हूं उन फिजाओं के लिए, कि हाँ मैं बना हूं उन ऊंचाइयों के लिए जो ऊंची तो बहुत है पर नामुमकिन भी नहीं, क्योंकि मुमकिन और नामुमकिन में बस इतना सा फर्क है। धूप छांव में फर्क बस इतना सा। तो बस चलिए फ्रेंचाइज इंडिया के साथ ये फर्क मिटा देते हैं। फ्रेंचाइज इंडिया।
Hello and welcome everyone to the ROI Show, a special webinar series, a platform to help you kickstart your journey towards owning a successful business in 2025. Over the next few days, we will explore key strategies to help you find the right business opportunity, secure fundings, and building a venture that delivers result. Today, we are honored to have a very special guest with us, Mr. Gaurav Maria, the chairman of Franchise India Group. With over 2 decades of experience, Mr. Maria has guided thousands of aspiring entrepreneurs towards success. Today, Honorable Chairman is here to share valuable insights that can help you take the first step towards achieving your business goals. Let's get started and give a warm welcome to Mr. Gaurav Maria. Over to you, sir.
Thank you, Bharat, and thank you for hosting this. Welcome, friends. Welcome to this very special webinar. We also have Sonia Chaudhary. She's the managing director. She will probably start the webinar and set some perspective why we're doing this webinar. And a very, very important time, because when you're getting into a new year, you're always thinking about starting your entrepreneurial journey, you're starting your own business. And it is very important question which comes to your mind, that what is the right ROI? And sometimes this is a very difficult to assess. And that's why we've created a 3-episode series. Today, we're going to discuss about selecting a business and selecting a business which gives you the right ROI, and also understanding a little bit on ROI. Tomorrow, we'll talk about legal and commercial terms, which are very important for you to do. And third, we'll get on to the business models, which are various business models exist. We get confused in franchising. What is a good return on a FOFO, which is franchise-owned, franchise-operated, or a franchise-owned company-operated, or FICO, which is franchisee-invested company-operated. We talk about all these. So if you're interested in starting your own business in 2025, these 3 days can be very important for your learning and building your own understanding about which business you should select and how you should assess a particular business. So over to you, Sonia, for starting the webinar.
Thank you. Friends, a very good afternoon to all of you and welcome to the ROI show. And thank you for joining today's session. And to get started, and just to add on, Gaurav is the chairman of the Franchise India Group. He comes with a very rich experience of working across various business industries at different stages of their life cycle, from startups to large corporates, and across different and very diverse markets across the globe. And we'll share a lot of insights on ROI. But before that, I'll also set a perspective to give you a little background about our company. We will also welcome any questions that you have and make the session a little engaging. And we'll also like to learn about our audience who's joined in today. So if you can also share a brief profile about yourself, would really be helpful for us. Like if you're already running a business owner, or maybe a franchise owner, or aspiring to be an entrepreneur. And if you can also mention the city that you come from. And so on the show, friends, we bring in insights on the ROI calculation, metrics and factors, and most importantly, the events that you must consider to understand the return on investment. Our group, Franchise India and Fran Global, our international entity. We operate in about 14 countries, about 97 cities in India, with a 90% market share. And the overall group capabilities create a lot of intelligent synergies, with the group's strength, which is leveraged by each of our business units. And we have big interest on franchising, licensing, real estate, mid-market M&A, and also market entries. And what has remained very consistent in the last 27 years of our being there in the business and the industry is, we have been a very big catalyst in the entire ecosystem and the space. And I would also say we have been a very big change agent to see the entrepreneur entrepreneur community actually evolve over this period. And something which has remained very, very important for us was always being investor centric and franchise focused as a company. And education sessions like these help our investor community to take an informed decision on buying in any form of business. So today's webinar is focused on understanding the return on investment, which is a very important parameter for any prospective business buyer who is considering to invest in any given business opportunity. And often we see this is expressed as a percentage or a ratio. Most of the times when we speak to investors, they talk about a certain percentage that they expect from a business to generate on an annualized basis. And this value actually describes anything which can be financial return on the investment, to also increase efficiencies in the business, to even sometimes an opportunity cost or a return which perhaps an investor or a business owner gave up to invest in a particular business. So ROI is very subjective, and this return has to be considered on various aspects than just formula. And practically every business decision that we take requires knowledge on understanding this ROI in order to optimize the profitability. So to ensure you're investing in good business, you should learn how to carefully calculate the business ROI. This means you need to learn about questions, more importantly, to be asked, and how to even verify the answers for smart decision making, and monitor your business over a given period of time. Something important before we get started on our presentation. So ROI is very different in different asset classes, and also the goal of the investments. And so if we take investments and categorize broadly into risk-free investments and risk investments, risk-free return, for example, in asset classes which are defensive, like your fixed deposits, will be low versus asset classes which have risk capital deployment, which means the risk capital should give you higher return over and above the risk-free return. So any business owner, investor expects higher over and above the risk-free return rate, which is the case of all active investment, like also the franchise businesses. And so when we talk about the overall ROI scape or the business landscape, franchising stands out as an example of stability, as it provides a big safety net of tried and tested methodology, the SOPs which the companies bring, and learning that franchisor is able to transfer that seamlessly to a franchisee. But this model is also a blend of lot of entrepreneurial spirit and established brand leverage, which offers a lot of unique avenues for consistent return on investment. So by aligning with a proven business model, investors, business owners, franchisees can leverage the equity of the company, the operational expertise, and ongoing support that paves the way for a sustained profitability. So let's go ahead. We'll talk about how do we calculate and different scenarios on which the ROI should be calculated. We also have a small presentation that we like to run through. But before that, I'll let maybe Gaurav also give his perspective on return on investment. And friends, like I said, I'll request you all to make the session interactive. Any questions you have, please keep writing, and also give a brief about whom we are actually talking to, so you can share your profiles. Over to you, Gaurav.
Thanks, Sonia, for setting the perspective. And friends, you can use the Q&A box. There is a Q&A box at the bottom. You can click that and ask your questions, and also introduce yourself. What brings you here? Are you looking to start a new business? Any timelines you have? Any particular industry which you want us to really highlight? Because Franchise India works with across different industries, both on the product side and service side. As Sonia said, very important for you to understand is that you cannot compare passive investments, which means that you do investments in gold, property, or stock market, or mutual fund, or any other passive investment, versus an active investment. Active investment is much more performing asset, but it also carries risk. So how do you really further define active investments? Active investments can be, you can invest within any business, which can be your own brand, or you can buy a franchise. If you buy a franchise, it's relatively lesser risk, because you're now getting into something which is already proven, the brand is already established, and you get a lot of know-how. And so your learning curve or your gestation goes down. So when you're comparing an active investment, obviously franchise, and especially if you are a first-time business buyer, you have no experience, going with a franchise is much better idea than starting your own brand. But how do you select a particular opportunity which gives you the right ROI? Before we even jump into getting into ROI, let's understand how to select a right opportunity. And I always give the 4 different stages which needs to be done. The first stage is how to shortlist the brand you want to really work with. If you're buying a franchise, how do you select the right brand? So I call it connecting the 4 dots. The first dot is selecting the industry before you jump into the brand and jump into even discussion on ROIs, because we get hundreds of people calling us every single day to franchise India, and their starting point is give me a business which gives the best ROI. There is no answer like that, and that's where the myth of ROI really starts. So you need to first understand which industry you want to choose and why. Strategically, do you have any fitment with that industry? Do you see that industry growing in next 10 years? What kind of disruption can happen in the industry? What have you seen the trends in the industry, not only just in your market, but other markets? And why you are particularly interested in this? This is very, very important question. And I call the 4 fits, which you need to see in yourself, which I call the strategic, financial, operational, and marketing fit before you even jump onto selecting the industry. So if you shortlisted, say, 2 or 3 industries, then the next dot would be selecting a particular brand in those industries, right? And why you're selecting a particular brand versus its competition. So then you have to get into a little bit of a competition analysis in terms of understanding why one brand versus another brand. Like we get a lot of people coming to us for F&B. Now, F&B can be classified into many, many different categories, and many different brands exist in that. In today's market in India, we should have at least 1,000 brands which are giving franchise in F&B. Why would you choose a particular brand versus another brand? And then you have to go into deep understanding of this brand's contribution, the obligation they have to support you, what kind of supply chain, what kind of training they're going to provide, what kind of marketing support they have, what kind of margins they're giving you. All that pieces has to be very well calculated to select and shortlist a particular brand. And then you have to go to the next goal, which is actually this webinar all about, your financial goal. What do you really want from the capital you want to deploy? And we'll talk about this is only not just capital by the money you're putting in. You also bring in a lot of other capital, which means your human capital, your time, your intelligence, your other contribution, all that also is part of your investment into this business. And what do you really see this as an investment turning up to you? And that would mean that you need to also balance your financial goal with your life goals, which means that what is your life goals, right? What is happening in the next 3 years with you, or what would you need 5 years from now, which your business has to support? If you don't define that, you will not come down to what you expect from the business. And so then you have to go back to the brand and see the financial performance of that brand or their past franchisees. That is this financial goal which you have would match that what is there in Dairy. And then you have to go to the 4th point, which is also understanding your micro market, where you want to run and operate the business. Every micro market is very different. Look at Delhi. A Rajouri garden would behave very differently to Greater Clash. The whole dynamics would change. The real estate would change, the rentals would change, the labor cost would change, a lot of things would change. And consumption would also change. We call in retail businesses throughput. The throughput would become very, very different. What you would have in south of Delhi to versus west of Delhi to north of Delhi to, and we are only talking Delhi. I'm not even going to Noida. I'm not going to Faridabad. And we're not shifting this market. This market would dynamically change, right? So say Levi store in Noida versus the Levi store in Gurgaon would perform very, very differently, right? So you need to really understand that what is the micro market. So first stage is to do this exercise, and and you need to have a coach or a consultant to work with you to do this exercise to select the right industry, the right brand, and your financial goal, and finally the micro market which you select. Once you have done this piece, it's not over. You go to stage 2 to evaluate this opportunity which you're doing. And evaluation has to be done on 3 parameters. First, you have to evaluate what is the life of this opportunity. If you start this business now, is this business going to last for 5 years, 10 years, 15 years, 20 years? Like in, say, if you open up a school, it can last for 100 years. So what is the life of opportunity? And before we jump into your ROI, we need to really see what is this, this opportunity means to you. If a business which would have to run 25 years for you and even gives you lesser ROI, it's a great business to be in, because 25 years you will earn on that business, right? And it can be legacy business, which you can pass it to somebody in family. So if that is a business, you can settle with a lower ROI. But if your business life is very small or short, then you need a higher ROI, because you need to cover all that in that period. Like look at restaurants, clubs, nightclubs. Nightclubs have very high ROIs, but their life is also very short. So you need to understand the life of the opportunity. Second thing, which is also very, very important, and especially for people who are getting into business first time, is ease of doing business. Can you manage this business? Is a business you can handle? Sometimes people are just chasing the ROI, but they don't understand that the business might be so difficult for them to really run and operate. I've seen a lot of good businesses going down because they have had a poor management. So you need to also see ease of doing business. Very, very important aspect. And the third aspect, which I actually most value, is what is the exit and value creation in that business, right? So this is where active businesses become different to passive businesses. So if I invested X money in a stock market, I have get a return of 20%. And when I withdraw, I just get that. But if I active business, if I invested and the business started performing well, I build a huge amount of goodwill or valuation. I can build a business which has sustainable cash flows and sell the business for profit. And this is where intelligent business owners do. They build businesses and take this entirely. So once you have evaluated on these three parameters, I'll repeat for everyone. One is life of opportunity, ease of doing business, and what is the value creation you can do in that business. That's a point number two, which you then, I think, once you have done that also, then you go to stage three, is how do you finance your business? Now, there is also a big problem happens. 70% of all businesses fail because of poor financial health. 70%. And why they fail is not because they didn't have enough capital to start the business. They didn't have enough capital to manage the business. Or they had a high cost of capital. People come to me, they say, I will borrow from the market at 2% interest and start a franchise. You are starting on the wrong note the first day. Your cost of capital is so high that you will never be able to sustain that business. And I've seen people going down in businesses in 3 months, 6 months, because they have no ability to support the business. Two very big important aspects for you to finance your business is one, that you don't leverage too much. And if you're leveraging still, then you need to see the returns which you're getting can service your leverage, right? Which means that if I'm on a interest rate of 10, 15, whatever percentage, it depends on where you're borrowing from and what structure you're borrowing from, your return has to pay for this. And if you feel that there is 6, 7 months or 1 year of gestation, you have enough capital to support that period also. Because you cannot get into negative cash flow where you have to pay your leverage and you're not able to do that. So financing your business is 70%. It's 70% of businesses fail because they have a bad financing of the business. So you need to really understand how to finance your business, which is the third stage. Then fourth stage is when you start the business, it's not going to perform the first day. You need to divide your business into 3 different categories. First is incubation. When you're incubating the business, you are also learning the business. You have never done that business. That time, you need to really work on different verticals of their business. You need to understand every single step. You need to bring what I call measuring the business, right? So you can measure everything what happens in your business. Then you get on to growth stage where you take the business on a growth cycle. And third is when you become sustainable cash flow business, which is sustainable, predictable cash flow business. And hence there is value being built. And there you can really look at even exiting the business and selling it for profit, because people cannot do this journey. A lot of people want to invest their capital in business which has already sustainable cash flow. So if you are an entrepreneur, start these 4 stages. First, connecting the 4 dots. Second, evaluating the business. Third, how do you finance your business and where is the finance coming from? And don't over leverage yourself. And fourth is divide your business. When you start your business, divide into 3 different cycles. First cycle is incubation, second cycle is growth, and third is building a sustainable cash flow. So friends, if you have any questions, you can ask on the Q&A box, and we will also run a short presentation. Sonia, over to you for running the presentation. And any business which you need us to really talk about, we'll be happy to do this. You can ask on a Q&A box. You can talk about how a F&B business works, how a laundry works, how a hotel industry works, any kind of business which comes in mind, which you are planning to start. You can ask about a particular dynamics, and we will give you what I call microeconomics of that business.
The presentation we can run. So friends, this presentation we already covered brief, sorry. We've already covered some aspects on the presentation. So we'll start with, I think this is something we talked about. In fact, what gets measured is something that gets managed. So two important metrics, which is one is return on the investment, and second is the working capital on a business. A lot of time when we work with business owners, aspiring business owners, they miss out on the working capital requirement that is required on the business. And any business where the ROI has to be calculated, it is very important to understand the working capital deployment in the business. Some businesses might be lesser on the initial investment deployment, but can be high on working capital, and it can be vice versa for certain businesses which might be high on investment, but comparatively less on the working capital. If you want to add
Very
on.
important aspect. And I'll give you a rule which is called 60-40 rule. If your business needs a certain investment, say you have 40 lakh rupees of capital investment to start the business, you need to have another 40% of that capital available as a gestation, right? So it's a 60-40. 60 goes into your capex and 40 sits with your opex. And working capital is very, very important. Look at retail businesses. All the retail businesses have rule which is called stock to turnover ratios, right? So if you are not adequately stocked, which means that you don't have adequate working capital, you'll not be able to compete in the market, and you will also not able to get the right kind of sales cycle. And that's why if you see like jewelry business, you see the old family jewelers, they still do very well because they carry a very high stock levels. And they are not able to, the smaller ones were not able to compete with them because they carry a phenomenal amount of stock value. So their stock to turnovers are much, much higher. So always think about working capital. Some businesses need a high gestation cycles, like healthcare. Say you start a clinic, it might take 18 months to come down to optimum performance. It might take 2 years to come down to a little bit of what I call peak performance. So you need to have 2 years the working capital will available with you to run that. It can be very different to other businesses which start getting positive cash flows from the first month itself. So you need to really see, as Sonia said, what is your business, nature of business, and what kind of working capital capabilities you need to build. Next. So this is a basic formula for return on investment. How you measure return on investment is the net return on investment into divided by cost of investment. So this is a basic formula, but we will in the next slide define what it is your total investment. How do you really calculate your cost of investment? So return on investment, if you see on a business front, what you're investing is a lifetime opportunity, lifetime value of the opportunity. There is an industry which the business operates in, the market conditions, cost of capital, and inflation. All these are your critical part in the business and that thing. But there are also personal risks you carry. You have your own risk, which you're taking, the investment goal, which is there, and your investment horizon, what kind of investment horizon you have. So return on investment, sometimes people don't understand what is it goes into business and what kind of return you get. You sometimes just you take one aspect, which is return on capital, what the capital you've deployed. But you have to also see there are other returns which are coming with the business, right? Or which you need to also see and manage. Like smaller businesses, you become an operator, you running your own self. The bigger return is return on your own time, you know. So you are doing the biggest expensive job in running your own business. So where is your return on time? And that's where the professionals sometimes get confused, because they can say, as a lot of people come to us who are in job and they want to leave the job and want to start a business, but they have a small capital. I advise them not to do it. Why? Because their return on time would never be matched in the business they want to start. Say you invest 20 lakh rupees. In a good situation, if your return is 30%, you make 6-7 lakh rupees. Now, when you calculate that I'm as a professional, I'm paid 2 lakh rupees, and if I invest 20 lakh rupees, I'm not even covering my own time cost. So return on time is very, very important, especially when you're doing smaller businesses. Return on intelligence, again, what you bring in beyond capital, right? It can be your intelligence, it can be your experience, whatever you bring in also has to have a return. Then your return on involvement, how much time you're putting into this business, what else you're bringing in. Sometimes you bring in also if other family members who are also involved. Then you also have social return, which means socially how much this business is helping you. Some businesses give you great social return. So if you start as a club, you build a very good network, a lot of people know you, you can socialize better, you have a lot of fun thing. And it's also sometimes emotional return, which means that is the business giving you some kind of emotional satisfaction of running that business. Yeah, you can lead this.
Since we talked about working capital and we created a very simple rule, which is the LPG rule for a smooth runway. Any business needs to have at least, initially we used to say we need to have at least 3 months of working capital. But any business needs to have at least a 6 months of runway working capital, which takes into consideration all your operating expenses. So working capital is the operating liquidity, which should be available for a business owner or any organization entity into a business. And it is also considered as a part of the operating capital, which includes heads like your rentals. It also includes inventory. A lot of businesses, especially the product retail-based businesses, require a lot of capital, which is used to put inventory or stock, so to say. So the three rules that we say on working capital is liquidity, so that you can have enough working capital to move, profitability, and finally the growth. So liquidity, profitability, and growth have become the three rules of working capital. And typically any business, in order to operationally break even, also takes about 4 to 6 months time. Right? So when I say operationally break even, which means that all your operating expenses which a business requires to run and operate smoothly, for any business requires about 4 to 6 months time. And by the time you hit your first year, you come to an optimum performance of the business. And most of the businesses, depending on the life of that opportunity, would start generating, I would say, returns from the second year, when they start reaching their optimum level of their performance. Anything that you want to add?
No, it's fine. Yeah, you can go next.
I think this is what we had to
So-
present today.
We have a few questions. We should start taking some questions. Sonia, you want to take the first question?
I think we have
So,
a question.
Pankaj is asking that present and the future, and others also can write a question. We have another 10 minutes to take all the questions. So you can have your questions on the Q&A box, and we will be happy to take it. It can be on particular industry or a particular brand or any other thing which you want to understand on starting your own business. So present and future of franchising growth in India versus franchise growth. Yeah, so Pankaj, if you're starting your corporate journey to business journey, that's what your question is. It's a very important decision, very sensitive decision. And because when you run your corporate life, you work hard, you save some money, and now you want to start your own business. First thing you need to ask, Pankaj, is that what are you bringing in outside capital in the business? So what is your strategic advantage, and which industry would get the maximum benefit from whatever you've done in your corporate life? That's the biggest capital you're bringing, more than the capital itself. Second thing you need to see, how soon you will need to replace what your current earning is, which means that you obviously have cost running in, you have EMIs running in. So how soon, how much time you have to replace that value? Because that's the first goal you want to do, because you have the kind of a structure. Third thing, that is this money coming from your own savings? And if your business doesn't take off as you thought, is there a plan B available with you? Or this is just a small portion of whatever capital you've generated, or you're putting almost everything. So that's also a very important thing, because it will keep a lot of pressure on you, because whatever you earned over your corporate life, if you are putting on all the risk, then it can become a very important aspect. And I will strongly say that for any professional who wants to start their business journey, don't rush into this. Spend maybe first month or so, I call the DATE, D-A-T-E. D stands for discipline. You bring in a lot of discipline towards your entrepreneurial journey. A stands for accountability. You bring in accountability with people around you. T, train yourself to become an entrepreneur. You might have done a corporate life, you might have run businesses for others, but this time you need to train yourself to do an entrepreneur role. And in entrepreneur role, there are many functions which are there. And it's almost doing everything in that business. And E is educate yourself on the business which you want to get in. So put a date. Date means that if you want to start your business or corporate journey, say month from now, this 1 month is a very important time for you to go through the whole cycle, which I explained in the initial part of the webinar, to select a business and also work with any of our consultants. We have consultants all over India. About 500 consultants Franchise India has, not only in India, but in 14 countries. They can take you through journey. Meet a lot of brands, meet a lot of companies, and then decide which is the right opportunity for you. Then there is a Mr. Menon who's also asked that there are specific opportunities for senior citizens. Yes, absolutely. A lot of people who are looking to invest, there are some even franchise-owned company-operated opportunities also. Like there is a brand called Chroma, which is Tata's backed brand. Obviously, return would be lower. A lot of people come with the idea that I want to invest into a FOCO, which is franchisee-owned, company-operated, but the return would go down lower. So you can invest into any of the businesses. You can invest in Domino's, McDonald's, a lot of these companies. The return is much lesser, but you don't have to really participate. And their credibility should be there. You should not invest into any franchise-owned company operated where there's not a credible brand behind it. Like Kalyan Jewelry, a great opportunity. It gives you sustainable income. It's not going to match franchise-owned, franchise-operated, but it gives you a sustainable income. And it is backed by a public listed large house. So your investment is, relatively safe. I would not use the word completely safe because there's no investment businesses which are completely safe. They always would carry a certain amount of risk. So friends, you have any other question also, you can reach out to us on our business hotline number. If you can put Bharat.
Yes. So,
our-
so in case, guys, in case if anyone if you would like to get in touch with us, you please get in touch on our hotline number 9717683838, or you can also write to us at feedback@franchiseindia.in.
So you can write down the number in the chat. So please do this. And if you need this presentations to be sent to you, or you want to look at this video again, or any other information you require, we'll be happy to do that. And if you are thinking of starting your business in the coming year, then it is a good time to really start evaluating different opportunities and then make a right or informed decision. I call the 3 stages of any business selection. First is information. You should get a lot of information on different businesses. Franchise India has about 4,000 videos on different brands, which are listed on our Facebook and our YouTube channels. You can go through that. This is all absolutely free. Second is evaluation. Evaluate your opportunity well. And third is negotiation, which means negotiate the contracts and the commercial terms with these companies. So friends, thank you very much for joining in. And if you are interested to continue to see all 3 episodes, tomorrow would be episode especially on the legal, how to negotiate a right franchise, which means how to go through the right legal contract and what kind of terms you need to go through before you commit yourself to any franchise. And third would be where we'll talk about the business formats in franchising. So thank you very much for your time, and look forward to speaking to some of you. And Sonia, over to you for the last words.
Thank you, friends. So we have shared our email ID, our contact information. If you want to connect with us, please let us know and join us tomorrow and day after, another 30-minute slot that we'll have on Monday and Tuesday. Have a great Sunday ahead. Thank you.
Thanks so much. Thanks so much, sir and ma'am, for being available for this webinar and sharing the valuable guidance on selecting the right kind of business. Thanks so much, everyone, for joining us. Tomorrow we will again join at 12 o'clock in the afternoon. Thanks so much, ma'am.
Thank you.